Okay, welcome everyone. We are here for the JHI webinar on legally avoiding capital gains tax and taxes with section 1202. Lance, thanks for doing this. Really happy to have you here.
Happy to be here.
So we have Lance Parker from PwC. He's going to start off by giving, I asked him to give kind of a general overview. This section called qualified small business credits, and also section 1202, even though it's been around for a long time, not a lot of investors understand it or utilize it very often. I see it as really a great program that the government's put in place that we should all at least learn about and take advantage of. But because it's less well known, I asked Lance to put together just some basics about how investors should think about it. What is the program? If it's so wonderful, like I'm saying and Jumpstart saying, why do people not really focus on it? So Lance, maybe give a quick background about you and then some slides. Before we jump into that, I just want to touch on logistics. And so we have a bunch of participants just now coming in. We'll be doing the slides. I have some questions I want to talk through, but we also want to answer questions from you, from the audience. And so you can either use the QA button and type in, or the chat. I'll monitor both during the time. And we have after about 20 or 30 minutes, we have time allocated to answer questions. But I'll also go ahead and just review it now. And if it fits with what we're talking about, we'll just throw it in right now. We'll answer it on the fly. So with that, Lance, maybe I think you have some slides you put together. See Sure. If you can share that for people to see.
Let me get that together. And let me know as soon as you see that pop up.
Yeah, I can see it.
Perfect. Great. So a little bit of background on me. I've been with PwC for a number of years, and I'm in the mergers and acquisitions group focused on partnerships. And so it's almost by accident that I ended up specializing in section 1202, which is qualified small business stock. There are some partnership provisions we'll get to a little bit later that really kind of roped me in, and it's a pretty small industry. Both at PwC, there's just a very small number of us that do this, so it's pretty highly specialized, and as well as across the country, individual practitioners are obviously taking a closer look at this. But it's been a lot of fun because, as Vic mentioned there, it's such a powerful section. It's also a decently complex one, as you'll see as I walk through some of these slides, which is why it's maybe less utilized than it could be. I want to give a start here and just kind of ask why qualified small business stock, why section 1202 in the first place. Really, to start with the punchline. And kind of the power that I was talking about, initially, is that there's potential to exclude up to $10 million of capital gains income. There's also, as we get a little deeper into this, potential to go much higher than that. And that's really, if we talk about a cash tax benefit here, we're talking about approximately $2.3 million in tax savings just from this single provision alone. But the IRS has made sure that we have to jump through a lot of hoops to receive that benefit. And also, just as I go through these, Vic, please feel free to interrupt me. We come at section 1202 from different perspectives. I'm looking at it from people asking me, well, does this qualify, or what do I need to do? And you're looking at it much more actively from what planning opportunities. So if I'm sliding by something that you've seen before, please feel free to jump in. And
yeah, I mean, I think in general the audience is investors, and my thesis is that if you know about this ahead of time, there are pieces you can plan for to make it easier to qualify, or you could maybe document things. I have stuff in our legal agreements that we can talk about later, but I think they're really helpful after the fact, just to have some of the evidence kind of embedded in. But yeah, let's just talk through it back and forth. I think this.
Yeah, and I would say that's that's a good point. The biggest mistakes I see are people that aren't They don't dig into it from the outset. So it's a wise plan to do that.
Yeah, but it's a lot of money. So maybe it's a lot of money if you're a billionaire, but $2 million is, you know, a decent amount of money. And then if you can accelerate that, we'll talk about more advanced strategies later, but it can be a decent amount of money.
Like I mentioned, there are quite a few pitfalls here, and I'm going to go through them. In some places, these slides, Vic mentioned, you know, this is recorded, so this is for your benefit to be able to see this after. Some of these slides, I'll kind of skip over some of the material because it won't serve us to spend, you know, too much time digging into some of the minutia. But just knowing that it's there and to watch out for it is an important thing. Like you said, most people on this call are investors, so we're focusing really at venture capital funds and private equity funds that are able to make these investments. But it's good to know also that, you know, there are a lot of other people that might be interested in it. You know, your founders of businesses, high net worth individuals, early startup companies, those types of things. As far as requirements, there are really kind of two tiers of requirements to think about, and then there's this third common considerations, just stuff to keep in the back of your head. So when I think of 1202, the way I think of it, there are certain requirements that the corporation has to meet, and then there are certain requirements that the taxpayer or the shareholder itself also needs to meet. So anytime I consult on section 1202, it depends on who's calling me on the phone. Is it the shareholder? Then we need to look at, you know, certain requirements. Is it the corporation because they're interested in attracting business investment? Then we need to look at other things and kind of secure that so that when they talk to investors like you, that they can say, you know, we are a qualified small business, we're engaged in the proper activities and have the right mix of assets, those types of things. A little bit of background on section 1202 is enacted in 1993. And really the purpose behind this was to spur small business investment, really underlining the small business. We'll talk later about that, but there are asset limitations in order for this to qualify, at least initially. There also, as part of this, they're kind of, if you think about Congress and what we often see as far as the dialogue coming from the Hill, they're talking about like almost Main Street jobs. And it doesn't, of course, shake out exactly that way. But the idea is they're not trying to spur investment in law firms, accounting firms, those types of things. They want you want to think about a product that's being created and not just kind of a service industry. Also, as I start walking through these different requirements, it's helpful to think about the intent because you can almost start to intuit the answers based on what Congress might have wanted, you know, when they enacted this. So I've broken this up to talk about the corporate level requirements, then we'll go to the shareholder level requirements, and then some of those considerations we'll kind of skip over those at the end, kind of discuss briefly, but not too deeply. So this is a flavor of what's to come. There's several different corporate requirements, basically 6. Do we have qualified small business stock? What percentage of your gain is eligible for the 1202 exclusion? Are you in a qualified small business? And have we satisfied the active business requirement? Some of these are going to get deep into the weeds. And I'm going to do my best to skip over some of that so you're not all, you know, wishing you had taken a nap rather than listening to me about this. Then some common pitfalls are redemptions and reorganizations. These are just transactions we see in corporations all the time. So it's good to know about them in advance so that you can plan accordingly. And I'll share at the end here a heartbreaking story about a company where that kind of caused them to blow their 1202. So that first requirement is, do we have qualified small business stock? So the requirement there is you need to be a domestic C corporation. You have to issue the stock after 1993, and as a shareholder, you need to have received that stock in an original issuance. So it's not going to help if maybe Vic buys a bunch of stock, he invests in a company, and then I buy that stock from him. He's going to have qualified small business stock, but as soon as I purchase it, I'm not going to have an ability to take that 1202 exclusion on it. And like I said, there's some active business requirements in there as well that talks about the type of assets you have, for how long you've been operating this business, those types of things. And we'll get into that in a minute. So next is, what percentage of gain is excludable? Got this fancy chart here for you. If this company, began or if the stock was issued before 1993, you're out of luck. Between 93 and 2009, we have this 50% exclusion with AMT. So AMT is going to apply to that, and that AMT applies all the way. Alternative minimum tax is going to apply all the way through September 2010. Just speaking from personal experience, and as you all are considering investing in various companies, that's not really going to be something you're concerned about now. You're investing after the 2010 benchmark, and the happy news for you, with that fact, is that you're going to get this 100% exclusion, which is kind of a spur as well for why we're seeing so much 1202 discussion now, as opposed to maybe 8 years ago, or even 15 years ago. There are some practitioners out there, some that were even involved in enacting this and kind of writing the statute, that have done this, since 1993. But the benefit was so small, compared to the requirements and kind of tracking things that you needed to do, that a lot of investors just said, it's not really worth it. Next question is whether you have a qualified small business. And this is what I was referring to when they wanted to really focus on small. And if you're investing in a company, it needs to have 50 million or less of aggregate gross assets. And the takeaway here is how they measure aggregate gross assets. That's going to be cash plus your basis in your corporate assets. If you've contributed assets to the corporation, basis for purposes of 1202 is treated as the fair market value at the time of contribution. We'll talk a little bit later about planning opportunities, but this sword cuts both ways. In some circumstances, that's going to cause somebody to blow their 1202. Maybe they contributed really high value property in it, and even though the basis is low for 1202 purposes, we'd say, we're sorry, you're not qualified. On the other hand, if you have some very low basis assets, maybe you're a founder that started this company and you've contributed in ultimately into the corporation, it can actually boost your basis number. And the reason that matters is the amount of exclusion that you're eligible for. Like I mentioned earlier, you've got this 10 million, or it can be greater. And that greater amount is 10 times your adjusted basis in the property. So this cuts both ways. It can hurt you, or if you're savvy and you're thinking about this on the front end, that 10 times that basis, which is your fair market value of those assets, can end up being a pretty large number if you time it right. I don't want to spend too much time on the active business requirement. The reason it's important, it's more important for you to be aware of it and then say, let me call Vic or Lance about it. But the reason I don't want to get into it too deeply is there's a lot of minutia here that wouldn't serve us for kind of a quick overview and introduction to why this is such a powerful investing section. But really what it comes down to is you need to have your assets doing the right stuff for the business. There are certain limitations on the types of assets you can have. Real estate, cash just sitting there, stock. You think back to the purpose of 1202. Congress wasn't really wanting to encourage, this influx of cash just for investment, just to, sit in the bank account, be invested in the stock market. They wanted it to go in and create products. And so those are going to be some areas that you have to watch. You have to stay within certain thresholds. Active business also refers to the types of businesses that you do. And this is kind of a threshold question you think about anytime you're looking to invest in a company. So I've got some prohibited categories here. Trades or businesses involving the performance of services in certain fields. That's your health, law, accounting, consulting. Consulting is a really broad category, and there isn't a lot surrounding this. We don't have regulations that tell us what that means. and we'll get into that a little bit later in our discussion as well. But it's important to think about these categories. And if it's on the line, that's when you want to call and talk to somebody about it. Really, I think the way to think of it is it service intensive? Is it a restaurant or a hotel where, I mean, they're really offering service, or is it more of a kind of a product type business?
Yeah, and I'll just jump in. I mean, obviously I do health investing only, exclusively. And the way I would view that is if most of the revenue comes from healthcare providers giving services to patients, a doctor's office, let's say, it probably is excluded. It would not work. If instead it is a product that is sold to help doctors do things more effectively, and really the business is in the process of creating and making and manufacturing and selling that product, then even though it's in healthcare, it's a product company, and I would argue would be included.
I completely agree, and in fact we have some guidance from the IRS that addresses those issues, and if we have time at the end, we can jump in and take a look at it.
I mean, I think your perspective of the intent of the law, I think, is a helpful. Like, they're not trying to create barbershops and consulting practices.
Right.
They're trying to create, product companies that are building value for the country.
Right. So to your point, that's going to entail something like, providing a product to a doctor's office or something useful in their practice, whereas the doctor herself or himself, they're not going to be eligible for this exclusion.
Yeah. So we had a question come in that I think would be applicable here. So would like a software as a service company work? And I think the question was to me, but I want you're really the expert at it. I mean, I think software as a service is primarily a software product, and then the way that they're pricing it is a monthly recurring price. But I don't know. What are your thoughts about that, Lance?
Yeah, that's an interesting question. So there are a couple different ways the software could work, right? You could say, hey, here's an app to connect people that are searching for a service and the service provider. And I would argue that could qualify because it's not actually providing the service. It's maybe a technology that's connected. It's a product that allows two people to find each other. Other circumstances where it has more of a service component to it. So maybe, and like I consulted on one engagement where they created kind of this software program, but it ended up having input, and I'm going to bring it back into the medical field just because that's who this was. That had some medical flavor to it, where some doctors were actually consulting and providing the product to the user. And so we ended up saying that no, that wouldn't really work. So I think that if it's something that's maybe providing, if it's a product to you in whatever the software is providing, there is potential there. There may be other considerations, like what are the inputs? For example, the one business where I said that it didn't really work out, we spent quite a bit of time talking to them and what they really did. Initially, we thought, hey, you're probably qualified, but the more we kind of dug into it, the more we found that there were really service inputs going into this ultimate product that maybe weren't visible at the outset. So if you're lacking some of that service flavor, I think your argument becomes stronger. I should also say, guidance from the IRS in this area is extremely limited. Within the health field, hey, are we in a health trader business providing services? There are 2 PLRs out there, that's it. There are a few other PLRs with 1202 generally, but they're not.
PLR, just so people that aren't initiated, PLR stands for what?
That's a private letter ruling. And that's where, any number of you might come to me and say, hey, I think this is qualified. I might be able to exclude $20 million of gain. And and we say, this is really close to the line. And so we go over to the IRS and we ask them. And so we ask them for a private letter ruling that would tell us individually, hey, we think that on your facts and based on your representations that this is qualified. The IRS is also fairly reticent to do that. But really the larger point here is where it's really close to the line, it ends up being maybe an appetite for risk.
Yeah.
Because I can't turn to too many things in this specific area and say, oh yes, right here it says you're good to go. It ends up being a judgment call. And that's why I talked about that service flavor or not service flavor. Yeah. It's kind of a sliding scale.
Right. So you get to a personal choice of do you want to risk an audit, and do you feel like this is within the intent of the law or not? And there's been a couple of questions coming in. I think,
sure.
Let me try this.
This would be where the questions come in.
What's that?
This would be where the questions come in.
Right. This is where the questions come in. So I guess the one of the ways I think about it is let's get out of healthcare. Let's say you are providing accounting services and you use Excel as part of doing your job, or you use QuickBooks, or you use other tools. You're using software tools, but you're billing by the hour and you are charging service. And then as a part of delivering that service, you're utilizing lots of tools, maybe even some macros in Excel you've created yourself that are proprietary. That's a service, and that is excluded. That would not count. If instead you create a new accounting software that you sell and you charge a license, then that's a software product, and it happens to be in accounting, but that would be included, I think. And so to me, it's more about the business model, or like, how are you going to market? Is this for instance, once you start recording hours and charging an hourly rate, it almost certainly is service related.
I agree.
Even if you have software you have created, and so one of the questions was around telehealth. So let's say I create a telehealth technology platform and I sell it to hospitals to be able to effectively do telehealth. That is a technology product I could charge for a user or for an enterprise license, and I'm creating a product and selling it. If I instead use that same product to offer telehealth visits, and I charge by the hour or by the visit for the service of delivering healthcare over my technical product, that's a service. And there's a lot of gray areas, but in general, that's the way that me as a business person thinks about it. Obviously, Lance can get into the private letters, and the IRS hasn't given a ton of detail, but you can get into as much detail as you want. But in general, the business is charging its customers for a service. And if this service takes 15 hours, then I will charge you half as much as if it takes 30 hours. That's a service, versus if you sell a product and that person can take the product and do whatever it wants with it, whether they're successful or not, they still pay. That's a product. So I don't know, Lance, does that make sense to you?
Yeah, and I think even going back to your accounting example, I think it's a good way to think about it. The accountant that's using Excel is not going to be a qualified engaged in a qualified trader business.
Yeah, even if he has created a bunch of super special proprietary reports and things in Excel, that's great. It makes him a really good accountant. Doesn't change his business model.
Right. The software itself, Excel, I could see an argument for saying that is a qualified small business. Say, hey, this is what's the difference between this and the manufacturing, ledgers and selling ledgers? Well, one's a digital platform, but really there's no difference in kind of what you're trying to accomplish with it. So I would argue that is a qualified small business.
Okay, great. Well, let's we might come back to this later, but this is like the most important thing I think is like what businesses would qualify, because the 50 million is pretty black and white, right? But
That's
the
right.
definition is harder.
That's a hard stop. Yep, you kind of know it. You look at the cap table and you say, are we good or no good on our 50 million?
Yeah.
This is much more gray area. We dig into the legislative history. We dig into a bunch of different things to try to figure out when things are closer to the line, when it's good or no good. There's actually some interesting nuance even in the restaurant business, but we'll get into that later if we have time.
Okay, great. Let's push on. We're getting some more questions, but let's get some more content out there, and then we'll circle back to it.
Sure. Okay, so I talked about this mix of assets. Stock can't exceed 10%, real estate, all that kind of stuff. There are some things that are okay. Startup activities, research, experimental expenditures, in-house research, those types of things. Like I said, this gets very nuanced, just good to have it in the back of your head as you're thinking about this. What about redemptions? Redemptions can blow qualified small business stock. And there are two types that we think about: related party and significant redemptions. Really, if we're just kind of going over the broader requirements here, I want to say if the corporation redeems a big enough amount of its stock, that can disqualify all of the issuances surrounding that redemption within a certain number of years. So it can be pretty punitive. And like I said, I've got a story later that just happened to me last week. But you, like, anytime you've got a redemption, just remember, just a little red flag there, because much of the time you can at least work around it if you're close to one of these lines.
Yeah, and just to be crystal clear, that is a year in front of and ahead of the issuance. So when the company is raising capital and issuing new equity, it cannot also be redeeming shares.
Right. So one of these is kind of the harshest one, is this significant redemption I've got down there below, because what that's going to do is invalidate all stock issuances by the company within a time frame, which is a 2-year time frame. Before, it's a 1 year before and 1 year after the actual issuance date. So if we just jump into this, we say, hey, if the issuing corporation redeems more than 5% by value of the aggregate of its stock within a year before or after any given issuance, that issuance is toast. The less punitive one, it's going to be hard on the individual shareholder, but it's not going to invalidate this whole tranche of shares that was issued, to any number of investors. That's our related party redemptions. That's where the corporation goes to just an individual shareholder and redeems them of, just a smaller amount, $10,000 for 2% of the stock held by that shareholder. That's going to, and we're going to have this 2 years on each. It's, instead of a 1 year on each side, it's 2 years. When they do that, it's going to invalidate that shareholder's stock. But that's a lot less punitive than, kind of wiping out all of the stock issued by the corporation within a certain window.
Right, and one of the parties to the transaction is the one that's affected.
Right.
The reason the significant redemptions is more important to me is that could happen in theory. That could happen, and other shareholders are not involved in it.
Exactly. Yep. And so you've invested and you think everything's great. Someone else gets redeemed. If that redemption is too big, then you find out later on that you've lost your qualified small business stock.
Yeah, and particularly, it happens pretty often in a growth equity round where investors come in and they put capital in, but they also redeem out early shareholders. Maybe a founding shareholder leaves. If that's over 5%, you need to pay attention, because you could potentially lose your 1202 for that issuance. You wouldn't lose it for earlier issuances, but you lose it for that issuance.
That's right. Reorganizations, You can, if you have qualified small business stock, you merge with maybe a company and receive in exchange unqualified small business stock. You can still benefit from 1202, but you need to remember that you're only going to benefit up to the gain that kind of accrued, we'll say, up until that point of the reorganization. So this one's a taxpayer friendly, kind of giving you a helping hand if you end up with non-qualified stock in a merger type scenario. So we'll jump to the shareholder requirements, and I'm going to move through these. They're not that numerous, but I'm going to move through these quicker so that we can get back to any questions, as well as Vic, any other things, kind of pressure points that you'd like to focus on, drill down on. Shareholder requirements. There's a holding period that you need to, as a shareholder, own the stock. What about transfers? That's our original issuance requirement. And then can partnerships own qualified small business stock? So the first thing is you need to own the stock for 5 years. If you sell stock before 5 years, there is some potential to not lose your shirt, but kind of the goal here would be to keep your stock for 5 years at least. Transfers. There are, because of this original issuance, they want to incentivize people to go and invest, kind of, your original investors. It's not a benefit that Congress wants passed from person to person to person through the stock market. So, or even just, privately traded. So in this case here, we have, some rules about transfers. Kind of I would say the default here is if you transfer it, you're in trouble. But there are exceptions, so it's always worth asking. Some of those are like gift and death, from a partnership to a partner, so I'm giving away the partnership answer. So if the partnership owns it and then distributes it out to its partner, it can still qualify. And
yeah, so where I think, Lance, people need to call you is in estate planning. If they come to PwC ahead of time and say, how do I make sure to protect this benefit? Usually in estate planning, you can use one of these exemptions to work it through.
That's right.
Either it's in the estate, so it passes at death, or it's in by gift or other things. And so that's the one exception I think can pretty easily, with some foresight, be accounted for. I can't sell it to you in any kind of normal market transaction and have it work. It just doesn't work.
That's right. And I think this is another one of those kind of themes that goes throughout 1202 is the smart times to talk to someone about it are at the beginning and at the end. And of course, having a few phone calls maybe scattered throughout the holding period to ensure that you're kind of doing things right during major events. Oh, we're about to do a redemption. Is this a problem? But it's that beginning and the end that's really helpful, and that's kind of the lion's share when I talk to clients about this. Can pass-throughs? Yes. So a partnership can own or can hold qualified small business stock, and its partners can benefit from that. There are some requirements here, though. If you think back to the original issuance, you'll be able to kind of intuit what this means. But you need to have been a partner in the partnership before the partnership acquired the qualified small business stock, and then your interest in the partnership once it has acquired that stock. If your interest in the partnership increases, that increase and the corresponding gain on the sale of the stock is not going to be eligible for Section 1202. If you think about that, that's kind of essentially the same thing as you buying stock through a partnership, and then if I sell Vic half of my interest, that would kind of be the same as me transferring him half of my shares in that qualified small business stock, and then it wouldn't be an original issuance. So good to get it through a partnership, but you're only going to receive that percentage or that gain percentages exclusion as your interest in the partnership at the time that the stock was acquired. Also, another thing to be careful of is contributions to a partnership. 351 is specifically called out. That can work, and you can still be qualified qualified. 721 is not, so that's your contributions to a partnership. That's not mentioned at all in section 1202. So we typically take the position that if you contribute, as a shareholder, you say, hey, I'm going to drop this into my partnership, then you may have just lost your 1202 benefit. So that's something else to keep in mind, is you don't want to, just once again, going back to transfers, you want to be very careful. You're falling within one of those permitted transfers and not something different.
Yeah, so I mean, I'm a VC, right? So a venture capital fund is the classic example. It's formed, and then the fund manager goes and makes several investments. If those fit other areas of the 1202 statute, then they would be allowed. You can't use a partnership structure to game the no transfer rules, but you can be part of an investment partnership, and that could be 5 friends. It doesn't have to be a VC fund. It could be 5 friends to get together, as long as it predates the investment and it's formed, and then that partnership makes direct investments.
That's right. And in fact, most of my clients are investing through a partnership. And like you said, venture capital, private equity, that's the lion's share. I'm talking to those groups, and I'm talking to corporations primarily, who are wanting to attract investment and therefore want us to, analyze their business, their assets, those types of things, so that they can go and talk to investors and say, hey, yes, we are a qualified small business. Have some other common considerations here, and I break these out. I'll kind of move through them briefly, but I'm not going to walk through the kind of the blown out version of each of these. But the common considerations here are there special reporting requirements? 1202 says that the Treasury can promulgate regulations that will require certain reporting requirements. Those don't exist right now, but something to keep your ear to the ground if it ever does happen, especially as this gets more popular. I imagine it's something that the Treasury would start paying attention to. Are there any anti-abuse rules? Vic just mentioned this the other, a minute or two ago, about really the intent of 1202 and not trying to circumvent that with a partnership or something. There's a section in 1202 that specifically talks about that. And there are certain things you can or can't do, and then it refers you to whether you are circumventing the purpose of 1202. This is important because there's some nuance there when we get into drafting opinions for clients. That there's some things there that you may hear about in the future. I won't spend too much time on them there, but there's some question as to how much force those anti-abuse rules are, how much force they have now, or whether there need to be regulations coming out from Treasury to kind of implement those. It's a little bit unknown. We take positions on it, but something to be aware. Exercises of options, warrants, conversions of other stock, exchange of debt. If you have an option and you exercise it, that's treated as originally issued stock. However, your holding period will not start running until you exercise that option. So it's a benefit that you can still benefit from section 1202 exclusion, but you do need to be aware that even though you may have received this option 5 years ago, if you only exercised it a year ago, that's a really long period of time, but if you only exercised it a year ago, you've still got to wait 4 years. Can you benefit from 1202 for state tax purposes? And the answer is, it depends. Some states, as you probably know, just adopt the 1986 code and all of its amendments, and in which case you're in luck. Other states say to a degree, some states say not at all. So I'm a Fed tax person, so that's not really my area of expertise. But when it comes to doing your state taxes, that's something that's worth looking into. A lot of times you can benefit from 1202 on your state taxes as well. This is kind of broken out each of the issues that I just referred to. There's some nuance as well for married taxpayers, but I don't want to spend too much time on that in this setting. So I think that brings us to an example, and then we can kind of toy around with the example, Vic, and go take this any direction that you'd like.
Yeah.
A and B, let's say they might be investors, they might be founders of QSB. I wrote QBS. And so, it's showing here that there is a possibility of investing through a partnership. And there are a lot of different things to think about here. There's documentation. Do we have an original issuance for these partners? What kind of assets are in the qualified small business? Redemptions, over the course of these 5 years, these are all different things you're going to want to think about. We have a 5-year holding period, and then the potential savings and audit concerns. So I'm going to, we can run through these, Vic, if you'd like, or
well, I'll just mention, and then let me just make a point, and then let's talk about a couple of questions. So I guess many of these things. So at Jumpstart, we make 30 to 45 investments a year. And so it's decent volume, more than an individual would do. But I think it's helpful to kind of check some of these boxes in the stock purchase agreement, so that it is embedded in the legal documents. And we don't have a law firm on, but certainly I can put you in touch with law firms, or we can do it. But the company would rep, and it would be right in the SPA that they are issuing this as an original issuance, that they have net assets, below 50 million, and then it obviously dates it. And so you begin building kind of a paper trail of several of these things that then as an investor, you don't have to worry about. Like, it's in the documentation, and then you may or may not hold it for 5 years. And the company may change their business model. And there's a lot of things that could happen, but you check off some of those things in every investment you do. And if there's some question and the company won't rep that they're under 50 million, then okay, let's dig into that and try to understand it now. I feel like you can almost push it onto the company that's issuing the stock in the legal documents. So have you seen that before, or is that? I've been doing that. Does that work for the documentation purposes?
Absolutely, and I think like you said, it helps to start building that file, because there are two ways this can go. One of them is that someone comes to me after they've just sold stock. Venture capital, private equity, we just sold $100 million of stock. What do you think? If they haven't built this, I spend a lot of time going through and requesting things from the corporation, all these different things. It's helpful from the beginning. Corporation says, yes, we'll still want to do some due diligence around that. We'll want to say, well, wait, what business are you actually in? Those types of things. But that's very different than us having to do this all from scratch. So I have seen investors that do that. I think that's kind of a best practice. That you start from the beginning and you get some of those representations from the corporation. And that's also when they're most likely to work with you. After you've sold stock, sometimes we've had challenges getting back to the corporation and saying, hey, provide us with this, provide us with that.
Right. They're less, they don't have a lot of time for you then. You're sold.
Yep.
All right. Let's touch on a couple questions. So I don't know if you can see these questions. Does Catherine Bizamore put in, does 50 million asset limitation include IP? Value is not really on the balance sheet, but it clearly has value. And so how does the service think about that, or how does PwC think about that? My guess is you would have to attempt to value it. But obviously it's a best efforts thing.
Yeah, I think there's going to be a degree of reasonability there. If you can fix the value of intellectual property, I think it needs to be included. It may be something that has great potential, but right now is just worthless. It's going to take 3 years of development and research and any number of things to really give it some traction. And I think that should be reflected in the value. So it may actually be worthless. An idea without execution isn't worth much. So
yeah, you may have exciting future potential, but fair market value of $100 or $1,000 or zero today because it hasn't been implemented yet.
and maybe one way to think about that is to say, well, what if this corporation transferred that IP offshore? What would be the ramifications under 367? You know, are we going to have to pick up gain on this intellectual property? If the answer is, well, yes, but very little, or nothing at all, then I think that should be reflected, you know, in your gross assets analysis.
Is there any connectivity to the valuation that is negotiated between an investor and the company? So like, for instance, let's say I invested $5 million into a company, they're issuing stock, and it's a new round of stock, and I negotiate with, and the CEO negotiates, and we agree the company is going to be worth 25 million, you know, in order to peg what I'm going to buy, what percent I'm going to buy. So post money would be 30. That would include my view of IP and his or her view of IP. Can that be used as a proxy for this, or does that have to be separate?
I don't know, that's kind of a gray area. I think that I would certainly think that it's a persuasive argument to make, or it's an argument to make at least. You say, hey, look, we've got this arm's length. The one reason I think there might be a drawback to that, which is the counter argument the IRS might say is, well, yeah, but you have an interest in keeping that low so that you can benefit from Section 1202. You say, well,
I might want to keep it low just to keep it low.
Right. And so I think it's at least a starting point in the conversation to say, well, look, you know, I mean, we have this arm's length agreement. We have people, as long as you have adverse interests, I think it becomes more persuasive. If you don't, if those interests are a little bit more aligned, then I think, you know, you'd want a little bit more documentation.
Yeah. And then just a technical question that I think I know, but I want to be very clear about. The valuation question we're talking about is at issuance. Like, so when I purchase the stock, obviously we hope it gets much more valuable later. That is immaterial to this question. I mean, obviously it's important for selling the stock, but the definition is at inception, when you're buying the stock, not what it turns into.
Right. So there's two things to remember with this $50 million aggregate gross assets test. At all times before the issuance of the stock, it has to be 50 million or less at all times. So if it bumps up for a day, that's it. And no more issuances are going to qualify. After it has to be 50 million or less immediately after. So if your gross assets are 25 million, Vic, you put in 26 million, that's going to be a problem for 1202. So immediately after, it needs to be 50 million or less. But then after that, all's fair. So
you want it to go up.
Yep, goes up to 300 million, everyone's happier.
Yeah, and then often, well, not often maybe, but I've seen times when my first investment qualified, my second investment qualified, but the third one didn't qualify because the company had grown up over that value. And so you, in one deal, you might have 2, 3, 4 issuances that are, I think the IRS views differently. And they each one get tested. And then when you sell all your shares 7 years later, you would pay tax on some, and you would have 100% exclusion or not pay tax on other series of stock.
That's right. Yep.
Okay. And then what if the company goes public? There's a question around, what does an IPO affect anything? So you maybe have like a 10-for-1 split, and then you go public. So now I own public shares, but I got them as an original issue 8 years ago. Mm-hmm. I believe that's okay. Is that okay from your point of view?
It is. And in fact, I'm going to take this opportunity to talk about my favorite benefit of 1202, which is the 10 times exclusion. Right. So Vic, you and I have a great idea, and we go into business together, and we form, instead of forming a corporation directly, we form an LLC or as a partnership or a partnership.
Almost every 2 founders do.
Right.
And we'll get some losses, and it's easy.
Yep. And we say, hey, let's ride this thing until it's worth $45 million, right? We grow it over 5 years or something. And it's now, we've taken it from 0 to 45 million. That day, we contribute all of the assets of this partnership into a corporation, and we receive stock. The basis, for purposes of 1202, like I talked about earlier, is the fair market value of those assets. It's not the basis to us, previously. So now, for purposes of 1202, our adjusted basis on that is our $45 million. So this is our 10 times exclusion. We could say, hey, I've put in property with a basis of $45 million. 5 years from now, we go public. Our stock's worth $450 million. That's all able to be excluded under Section 1202.
Yeah, so that's the beautiful thing, is it's the maximum of 10 times your basis or 10 million. It's not the minimum of that.
That's right. And you can actually, we see clients do both. So what they'll do, the 10 million exclusion is a one-time thing. And in any given taxable year, it's one or the other. Of course, the 10 million is only ever going to happen once. But after that, any number of times you sell stock, it's going to be your 10 times basis. And so however you can maximize that number, that's going to be the way. So sometimes I'll see people do a $10 million exclusion in year one. In year two, they don't have 10 million left, but they've got 10 times whatever their basis was. And so they'll take that exclusion. Another, I don't know, $100,000 or $2 million, whatever.
Yeah. And so it is acceptable to do an LLC, take losses for 2 or 3 years, and you're building value, then you convert. My question is the holding period. I think the holding period starts then.
That's right.
Yeah.
That is the one risk. You could be going gangbusters as an LLC, and once you incorporate, things could fall flat. So it is a risk. But if you're confident that things are going to continue on an upward trajectory, I think you're in a good position to say, let's incorporate, and this could really be a benefit for us.
Yeah. Okay, and then we have one more question, but feel free to type in other ones in the last few minutes. So the last question, and the one I had as well, is there a sunset provision, or what happens if a new administration, I mean, say a Democratic sweep, do you think there's a chance this will change over time?
I think it'll probably change over a long time. I don't know. So I have a few friends on the Hill that are not, like on the Democrat side, that are not fans of 1202. And but I think there are a couple things to think about. Number one, we're in the middle of COVID, and so I think Treasury, the policy right now is taxpayer friendly. Let's keep business investment strong. Let's let's rock the boat as little as possible. So that's kind of
particularly for small business.
Right.
And they may be upset at like what I call the tech titans.
Yep.
But for small businesses, it's pretty friendly.
Right. If you and I just started a small business and they take this away, we're going to be pretty upset.
Yeah.
So I think that's one thing that's in favor of keeping 1202 around. I'm also of the mind that they can change 1202, even if there were concerns that, big money was benefiting too much from Section 1202. I think there are ways that they could limit that with it still being kind of a boon for small businesses and getting them investment. So I think that there's a good chance that this sticks around for some time. Now, I think the likelier possibility is that we get, as this has become more and more prevalent, we're in 2020. The first time people were going to even be buying stock that could be eligible for the 100% exclusion was 2010. And, of course, it takes a little while for people to get used to the idea or even find out about it. So, the last 2-3 years is really when we're seeing people take advantage of this for the first time. So I think the likelier possibility is that Treasury starts writing some regulations under 1202 that might try to target, situations that they find more abusive. There are some projects. There was a series of articles that came out recently, actually encouraging Treasury to come out with regulations expanding the application of 1202 because of the coronavirus. So there are voices in the community saying, no, let's use this to really prop up the economy and help create jobs in a time when people need it. So I think there's still
long term. I mean, it's a 25, 27 year statute. I mean, so this is not a new thing. And
Right.
it's going the other way, really. Like they've made it friendlier and more accommodating over time. Now that could swing back, but
Right.
it's been a good section for a long time.
That's right. Yep. And there are no sunset provisions or anything. There's nothing in there. There's no trigger right now. So now is as good a time as any to get involved in.
Yeah, right. And so just a couple of just cleanup items to make sure I cover these questions. So we covered it, but I want to make it very clear. The first investment is eligible in a company, but then a new issuance, whether it's called Series A or B or 5 years later or 1 year later, the same qualification tests apply, but every new issuance is eligible, assuming it hits the different thresholds.
Yep, I've many of my clients 4, 5, 6 issuances. It may end up being that only 4 of those, maybe only 1 of those. It'll all depend on all those other factors we talk about. But if all of your requirements are met, all 6 of those issuances can be good.
Yeah, and then there was a question around. Let's say you have a company with a couple of different divisions, one that's product and one services. Is there any kind of evaluation of the amount of revenue, or can you break it into halves, or any way to approach that?
Yeah, this goes to the part that I skipped over a little bit. So if you go back to the recording,
I should call you and engage you, and then we can get into this detail.
That's right. You can call me, but also if you go back to the recording and look at some of those slides, that's your active business requirement. And what it's saying is that a certain number of your assets need to be employed in a qualified trader business. So it might be that you're in a qualified trader business, but you've got something on the side. You're providing some types of services. And,
yeah, like my software product, when it breaks, I fix it, and it's 3% of the revenue. Yep. That is, doesn't disqualify me to have that little bit.
Right. So you'll look at the assets over the 5-year period, or however long you've held the stock. And so there are a couple different tests. There are 2 different tests that you end up looking at, but there's kind of a substantially all requirement that we look at. And in that case, I would say substantially all is not a service. It's definitely kind of your product. And I would say that that's qualified.
Yeah. Yeah. And then the last thing I want to touch on in the last 2 minutes is, if I don't hold for 5 years, we can roll it over into another qualified small business. It gets pretty complex as far as how to roll over and how to do that very carefully, but it is possible to do. It's called 1045, I think. Is that right?
That's right. You have a section 1045 rollover, and there are a couple of requirements to remember with that. Number one, your initial qualified small business stock that you've sold and you're wanting to roll over the gain rather than recognizing it immediately, you need to have held that for at least 60 days. You need to, 6 months. And then you need to purchase the new qualifying small business stock within 60 days. So own the stock, or the first set of stock 6 months, buy the second set of stock within 60 days of the sale of the first. And then your holding period tax. So if you held the first, company's stock for 2 years, you roll it over in 1045, and then you hold the next set of stock for 4 years or 3 years. You've hit 5 or 6 years, whatever it is, to meet 1202.
Yeah. Well, Lance, thanks for walking through this. I'll say I've been following it since 2010, and like the second best thing in the world is sending an investor of mine a whole bunch of money after a sale. But the best thing is sending them a whole bunch of money and telling them, and we used 1202 6 years ago, so you don't have any taxes right now. And it just, people are so emotional about taxes that it's just fun to not have to pay a tax due to legal reasons.
Those are the best calls I have. The worst calls I have are when people say, hey, I got this issuance. It's been 6 years. 11 months and 2 weeks later, there was this redemption, and I say, oh no. If you had waited 3 weeks, we'd be having a different conversation. So it goes both ways. Some of those are the best conversations, and it kind of underscores the benefits of paying attention over the life cycle of the investment.
Yeah. So just last question, trying to sneak in under the wires. What if you sell in 4 years and 6 months, but there's a couple payments that happen and it clips over that 5 year? I think it is at the time of the actual transaction, but what is your view of it?
So that actually can get a little bit nuanced. Contingent payments, depending on what, kind of what the contract says, we might say that the sale date is that 4 year, 6 month date. Or if there's some other things that have to occur, then you might be able to stretch it out. But I think that the more conservative answer is to say that you sold it the day of, and the contingent, you've chosen to take payments over however long a period of time. But that's a separate matter. But there are some nuances with contingent payments, like I said, that are worth talking about if you end up facing one of those circumstances.
Yeah. Okay. Well, exciting topic. A lot of nuance, but really, I think something that investors should be aware of and to try to work into their portfolio. So, Lance, thanks for talking me through this. It's been really helpful.
Thanks for having me.